What if I told you that 82% of business plans get rejected because of critical mistakes in their financial projections? Hi, I'm Kenneth Peary, and after working with hundreds of small to medium sized businesses in creating fundable business plans with the very idea of seeking investors to fund these particular businesses, there are certain things that are found out that could help you if you are creating or generating a business plan with the aim of getting funding from investors. Now, these critical mistakes usually happen in the financial projections. So, in this video, we're going to focus on creating financial projections that work. Please do stay to the end of the video because I'm going to give to you my secret sauce that makes for a fundable business plan. This exactly are certain hints, a certain twist, and something that you must tweak here and there in your financial projections to make them work. Also, feel free to download this free template. I'm giving it out for free to you so that when you're doing your financial projections, you can apply some of these tricks, and it's down in the description down below. I'll leave the link there. It's a free financial projections template. Hello, this is results-oriented preparation. Thank you for tuning in. If you're new to the channel, please do subscribe so that you can get notified every time we bring fresh and exciting insights on business plans, on financial literacy, and on running your business so that you can scale up and make it a success. Also, don't forget to like the videos and share with your friends, your entrepreneurial friends and others so that we grow together in this particular community. Okay, first things first, why do financial projections matter? Now, the first and most important reason for having financial projections is so that you can show prospective investors that the business idea that you have is a profitable one. Basically, what you're trying to say is that this is a business worth investing into. So, if your financial projections are done well, what they must reflect is that this is a business that is worth investing into and it will generate the expected profit that you have laid out in your plan. Secondly, the financial projections will highlight exactly where the money is going to and where the income will come from. The people that are investing into the business, they want to know exactly what you're using their money for. They want to see exactly the cost structure of the business, where most of your costs are going into. And remember that these are people already that have got a know-how in terms of running businesses. In other cases, for instance, that financier may bring someone who has got in-depth knowledge of the particular industry or sector in which you want to venture into or in which you're already operating if you are already into business. Therefore, they will know the ins and outs of that particular business. And therefore, you need to show that these costs are costs that can be incurred or are costs that can be restricted as far as that industry or that sector is concerned. And also whether or not you are able to raise these kinds of incomes in that particular business sector. And the third reason for having financial projections and why they matter is that they must also or they do reveal risks if there are risks at all in that particular venture. Now, it is impossible to run a business without facing any risks. Now, financial projections, if done well, will show exactly what the risk factors are, where the risk is, so that you can have a risk management plan to deal with those potential risks as and when they occur. So you don't really need to hide them, but you need to show in a plan that you are aware of this. And if you are aware of them, then probably you've got a strategy to deal with them as and when they occur. All right, now to create financial projections that work, There are 5 components that are usually make sure that all the financial projections or every other business plan has that. Now, let's break them down. The first one is the income statement projections. Now, the income statement shows the performance of the business. Now, in this case, as we said earlier, that profitability is an issue as far as a business venture is concerned. So, therefore, you need to show in your income statement whether the income and the expenses that are going to be incurred can make this a viable business. But there are also certain things that people will always overlook, and mistakes usually are found in this case because people have failed to really interpret what works and what is profit and so forth. Now, the first thing in your income statement projections is income. You need to show exactly where the income is coming from and calculate exactly how much income is coming in. Now, in most financial projections, if you're dealing with a tangible product, this will be known as sales, or it could be just known as revenue. Now, your revenue then must take away or must be able to cover the cost of sales. So if we say sales minus cost of sales, this will give us what is known as the gross profit. Now, a lot of businesses stop here thinking that the gross profit is the profit that the business makes. But there are still other hidden costs that you have really not thought about that can actually reduce the profit potential of your business. So let me give you an example. Let's say you want to open a coffee selling business. You have determined through research that you will sell a cup of coffee for 10 Rand. And after conducting research, you also have determined that you're expecting a minimum of 80 people to come through your doors on a daily basis. And you are going to be open for 365 days in a year because people drink coffee every day, Christmas, holiday, or whatever the case might be. So you have determined that this is the minimum number of people, 80 at 10 Rand times 365 days in a year. It means that you are going to make a sales or revenue of 292,000. That is the amount for the year. However, this is just income. If you take then the cost of sales or the cost of goods, how much did it cost you to get the coffee, the sugar, and so forth? This will give you the cost of sales. Now, the cost of sales, let's say for this business, the cost of sales is around 105,000. Now, that makes it 35% of your total revenue. All right. However, if you take your sales, which is 292,000 minus the 105,000, now this will give you somewhere in the regions of 187,000. Now, this 187,000 is not your profit that you're taking home. This is your gross profit. Now, on that gross profit, other businesses will still have other operating income. Let's say again, in this example, what you were renting was a bigger space and you are only occupying part of it with your coffee shop and a little bit of storage. So you still have got a lot of space that is left out that you decide to lease out to another business, which means as a business, you're going to be making rent income. Rent income goes into your operating income, other operating income, which means over and above the 187,000, you are making additional income. However, there are still other expenses or other operating expenses or costs that you need to subtract from your total income so far. Now, you can think of costs such as your water and electricity, telephone, think of advertising, think of insurance, and so forth. And if you've got a loan, a mortgage, all these must be subtracted from that particular income, meaning that you've got repayments, rent expense, and so forth. Then all these will be grouped under what we call operating expenses, and you subtract these. After subtracting that, you get your net profit. So just to round it off there, you have your gross profit, which is made up of sales minus cost of sales, and then you take the gross profit, add other operating income minus other operating expenses. This now gives you your net profit. Now, this is the actual value of the profit that you're making as a business. The next component for your financial projections will be the cash projections. Now, the cash projections usually are time based. You need to specify the time for which you are projecting this. So, which means first and foremost, you need to consider all cash items, all the money coming in and the money going out of the business. So, in this case, we're looking at money coming in and then subtracting the money going out. And then at the end of a financial period, then we have a balance there. All right. So, if you've got purchases, purchases are going to reduce your cash. If you've got payments, they are going to reduce your cash, and you've got income, sales, and so forth. These will increase your cash, but always take into consideration that we are including all cash items. All right. Now, oftentimes I break these into either 6 months, 1 year, or up to 18 months cash projections. Now, the cash projections then can then be projected into other time frames, but for cases of validity, you need to make sure that you reduce the time frames. 6 months to a year is most preferred. Now, the reason for this is there are other changes or other unexpected changes that are going to happen in the year. One of those is inflation. If you know for sure that there are certain items within either your expenses and so forth that are subject to annual price increases, these must be included in your cash projections. For instance, if you know that ESCOM raises their prices or their fees somewhere around June, you need to actually make sure that you cover this in your projections. If your water bill is subject to increase, if your telephone bill is subject to increase, all of these expenses must be factored in so that at the end of the day, you have a better reflection of what is going to happen. Remember, since we're still projecting, this is not the actual thing that is going to be happening. However, it has to be as close as possible to what will happen when that financial period comes to an end. The third item that we need to consider then is a balance sheet projections. Now, in the balance sheet projections, the main focus here is going to be the accounting equation. The accounting equation states that assets equals owner's equity plus liabilities. So in your assets, you are considering all the possessions of the business. It could be fixed assets, land, buildings, and also financial assets, current assets, non-current assets, basically everything that the business owns. What is the value of the assets of the business? Now, you'll see that I am separating here. I'm saying the value of the assets of the business because what the business owns must be separated to what the owner owns. However, if you go to owner's equity, you'll find that under owner's equity, we're talking about what the owner has claimed to in that particular business, which means these are the things that the owner has claimed to or owns that are invested in the business. For instance, if as a business owner, you invested your own 100,000 into the business. Now, this means that you have put in capital. Then the owner has got a claim so far of 100,000 in that particular business. So this is part of owner's equity. Now, it must be clear what is owner's equity, what are assets, and then this takes us to the third item. Remember, I say that assets equals owner's equity plus liabilities. Now, liabilities are what the business is responsible for, what this business is accountable for. It can be to creditors, it can be to certain bills that must be paid by that particular business. Now, this is the general rule. If investors are looking at your balance sheet, what they are focusing on is your business able to keep liabilities at a minimum? Or are your assets big enough to cover your liabilities? If a business is unable to cover its liabilities, now oftentimes you've heard that a business is being liquidated, which means probably it does not have the cash to pay its liabilities. However, certain times also liabilities can end up overwhelming the assets of the business. Now, this is a no-no, especially if you are looking for funding. If you are looking for funding, your assets at all times, you must be able to show to your prospective investors that you are able to cover your liabilities with the assets that you have, especially the current assets. Then we go to the fourth component of your financial projections, and the fourth component is the break-even analysis. Now, in the break-even analysis, you want to compare exactly the revenue that is coming in and your expenses or your cost. Okay, so if we compare the revenue and the cost, and we get to that point where you are at equal, right? Where you can now be able to pay all the factors of production that were used in the production or the service offering of that particular business, then we have reached what we call the break-even point. Meaning that if you are renting, rent is paid, entrepreneurship costs are paid, capital, the interest for borrowed capital is paid, as well as wages for the labor are paid. If all things are covered without getting an extra income on top, we say that we have reached a break even, meaning that revenue is exactly equal to cost. This is the break even point. Now, the significance of the break even point is that this is the point at which you begin to make a profit. Any income that comes in over and above the covering of all costs, now you have ventured into the profit realm. You are now making profit because you are able to cover your cost. So in doing the break-even analysis, you are showing your prospective investors exactly what it will take for that business in terms of income to cover the cost outlay of that particular business. So this is quite significant. Remember, the break-even analysis is important because it shows us exactly the point at which you begin to make a profit. The fifth component are the key financial metrics. Now, if we're looking at financial metrics, in brief, we can say that these are the storytelling numbers that tell exactly where the business is going or how the business is performing. Now, there are a lot of metrics that you can use, such as return on investment and so forth. But my advice here is that always use internationally accepted metrics, or in this case, in financial terms or financial accounting terms, we call them ratios. You can look at ratios such as the liquidity ratios, which has got current ratios in there, which compare current assets and current liabilities. Look at other ratios such as sales turnover ratio, debt equity ratio, and so forth. Now, these are internationally accepted ratios or metrics. Why is that important? This is because as a business, you might not be limited as far as getting funding, either locally or other investors from other countries seeing how profitable your business is, might be interested in investing in your business. So it is always advisable then to use internationally accepted standards of measurements or metrics that are endorsed by accounting associations worldwide. So you make sure that you put a section in your financial projections where you are now using those metrics to prove that what you put in your income statement, in your balance sheet, in all the other instruments that you put in your financial projections can be backed up by these financial metrics or ratios. Now, let me just give you the secret sauce of what makes financial projections that I've done for businesses, what has made them get the funding that they were looking for. Now, if you really put these or include these in your financial projections, the chances are that you will always get ahead and you will always get funded. Now, these are some of the things that I include in there. Make sure to pay attention at this. Every number must be backed up with solid research and assumptions. Use industry benchmarks from reliable sources such as Stats SA. Reference market research studies and competitor analysis. Include local market data and demographics. Include operating metrics. Acknowledge and plan for risks. Provide clear assumptions. Link to strategic initiatives. Now that you have an idea exactly on how financial projections are done in the business plan, what I will advise you to do is make sure that you go through the video again, take some notes, and also make use of this free financial projections template. You can download for free in the description down below. I've left the link there. Just download for free right now. Otherwise, I'm interested to hear from you exactly the type of challenges that you're facing when you are creating your own business plans. What exactly are you challenged with, especially when you're looking at creating financial projections to make sure that you've got fundable business plans? Also, leave a comment if you're interested in getting help from us. We are available to help you. This is exactly why we do this, so that we can give you a young and upcoming entrepreneurs the right kind of support that you need to get the funding and to scale your businesses. Don't forget to subscribe to the channel. I really hope you like this video. We'll see you in the next video. This is results-oriented preparation. Thank you for watching. Bye.